So I think what I would like to do is to distinguish between the pre-talking about tapering, leading to tapering, and making I guess, a break between that aspect, which of course is very important, but then liftoff, interest rate moves being a discrete, different component of the change. So I think you could see some very mild, very, very mild linguistic changes, potentially warming us up for a bit of a talk in July or August. I note in August we've got the Jackson Hole 3-day event, which perhaps would be a good venue to talk a bit more fully. It gives the opportunity for the Fed to talk a bit more fully around these issues. So I think there is the potential for the change of a word or two. But for us at the BlackRock Investment Institute, we don't think that means necessarily that rate hikes are going to happen anytime sooner, even if we do see that change of language, because tapering and liftoff are not the same thing. At least that's how we think about it.
Oh, yes, indeed. In fact, one of the fixed income prominent fixed income fund managers was telling me about how tapering is not inflation driven. Ben, I do want to get your thoughts in on why is the market being so complacent around inflation risks? And do you think that that just means that the market is perhaps setting itself up for a disappointment or a shock down the road if things don't go as per plan? Because right now, every survey indicates that a majority of analysts out there feel inflation is transitory and that by the end of the year, things may cool off.
I think, as ever, perhaps it depends what you look at. I guess some traditional kind of inflation plays, be that equities, the oil price, tips has obviously come off a little bit, but it's still done quite well over the last longer time frame. So I think some market views, plays on inflation have done what you would think. But to your point, and to slightly read into your question, the dog that hasn't barked has been yields. I mean, the US 10-year yield, I think, has surprised many investors and market commentators by going broadly down over the last couple of months. For us, within the BlackRock Investment Institute, this makes sense. So we have a framing that we call the new nominal, which is the idea that the Fed and fiscal authorities are going to be very much working together in what we term a policy revolution, this blending of fiscal and monetary policy towards broader social aims. And as part of that, we think the Fed is going to continue to keep the cost of money somewhat cheap to facilitate that broader agenda, let's say diverse and inclusive growth, or what we in this part of the world might call a kind of more social harmony framing. So we think that is going to continue to keep the Fed erring on the side of keeping rates a little bit lower than others may think, and hence the movement over the last month or two for us kind of makes sense.